Trevor Greetham is Director of Asset Allocation at Fidelity International on the phone with us now. Just give me your thoughts, your reaction to the volatility that we've seen in the markets over the past few days.
Yeah, well, the first thing to say is that the move in stocks, when you compare it to government bonds, so stock performance versus government bonds, has been really shocking. And that is something that happens when there's a downdraft in global growth. So if you think about the way that the markets traded after the Euro summit and after the US debt agreement, these are supposedly good news triggers, and the markets rallied for about sort of 2 hours in each case and then sold off again. And I think what we're now seeing is that there is a slowdown in global growth going on in the background. And I think the disappointment yesterday was the markets want central banks to ease policy, and what they're getting instead is intervention. So the Swiss National Bank, the Bank of Japan, the ECB, it's all intervention, and rather than monetary ease, and the Bank of England skipped. I think the Fed on Tuesday will be very critical.
Okay. So this is what the markets are really pushing governments to do, or I should say central banks. They want them to pick up the baton. They're saying growth isn't good enough. You guys need to step in to boost growth. You need to do something.
Yes, I think the Fed will feel that pressure. And one of the good bits of news out there is the very sharp drop in the oil price, because the impediment to central banks easing policy has been that inflation's too high. So when the Fed meets on Tuesday, they'll have an oil price that's dropped really quite significantly. They'll have the downwardly revised GDP numbers. The one question they'll be asking themselves is this a temporary slowdown? They said last time they met that it was a temporary slowdown. What could they say in 1 month that would make them convinced it's now a permanent slowdown? It's very difficult, and the ISM survey in particular was distorted by the fact that some of the respondents thought there was going to be a government shutdown.
Yeah, a raft of weak economic data, and of course all eyes on non-farm payrolls today. What do you need to see to make you feel a little bit more confident about the situation?
Well, I think it's one of the strange situations, actually. If there was an extremely good payrolls number today, I think the markets would rally very strongly off an oversold reading, and people would then start to say, well, maybe things aren't collapsing, and there would be a bit of a bounce. But lead indicators are still quite negative, so I would be tempted to sell into that bounce. If it's quite a soft number, then it raises the probability that we get some monetary ease next week, and that will give you a more sustained recovery. But I think it's very hard to call the Fed.
All right.
They may well just do something verbal. So it's not very helpful, but as some traders sometimes say, it's too late to sell and too soon to buy at the moment.
Okay, so does that mean you're staying away from stocks?
I run multi-asset funds. So the multi-asset strategic fund I run is heavily overweight government bonds, it's overweight gold, it's very underweight commodities. Stocks I've had a sort of fairly neutral position on, but defensive within those stock positions. If we get a sort of bounce, which is just a technical bounce, and we don't get central bank ease, then I would be tempted to sell a rally. If we get to central bank ease, then I think what we learned last year is it has to be big, and the response of the commodity and stock markets will last more than 3 or 4 days, so it doesn't really matter too much if you miss the first bit of it. So I'm sort of sitting on my hands a bit here. If there's a good rally with no fundamental support, I'll be selling more. If we get a substantial policy ease, then I'll be buying.
Trevor Greetham, Fidelity International, really good to get your thoughts. Thanks very much.